Good morning, everyone, and welcome to a presentation of Ocean Yield's Q2 2020 results. My name is Lars, and I'm Head of Investor Relations. As usual, we are broadcasting from the TIF, but due to COVID-19, it will be a webcast only. As normal, Lars Solbakken, our CEO, will go through the key highlights for the quarter, followed by Eirik Eide, our CFO, that will go through the financials. After that, we'll open up for a Q&A. After the presentation, if you have any further follow-up questions, feel free to contact me directly. And with that, I'll leave the floor to you, Lars.
Thank you. Ocean Yield declared a dividend for the second quarter of 5 cents per share. We have now declared cash dividends for 27 consecutive quarters. EBITDA for the quarter was 86.3 million. EBITDA includes insurance claim and other related revenues of $27.4 million. EBITDA adjusted for finance leases and excluding insurance claim and other related revenues was 86 million versus 81.7 million in Q1. Net profit after tax was 16.5 million. Net profit after tax was negatively impacted by a refinancing cost of 3.6 million and net loss of 1.6 million from Connector, 2 million from Fars and Far Statesman, and 2.8 from discontinued operation, which is the FPSO. Adjusted net profit from continuing operation was 24 million, of which 21.3 million is attributable to common shareholders, and the remaining is to the hybrid and minorities. If we look at recent events, in June we made a joint venture with Aker Capital for 4 LR2s and 3 Suezmaxes. The Navigate Aquamarine was delivered in June and Navigate MSC in July to Navigate chemical tankers following exercise of purchase options with net cash proceeds of 9.7 million per vessel after debt repayment. We also took delivery of the Newcastlemax new building Mineral Condor in early July with long-term charter to CMB. The car carrier Höegh Xiamen was declared a constructive total loss after a fire on board the vessel in June. Insurance proceeds expected to be about $26.3 million is expected to be received later in July. If we look at the joint venture with Aker Capital, the joint venture consists of 4 LR2 product tankers with long-term charter to Navigate Group, 3 Suezmaxes with long-term charters to Nordic American Tankers. Aker paid $10.2 million for 50% of the equity, and Ocean Yield are owning the remaining equity. Ocean Yield will continue to guarantee the secured bank debt against a guarantee fee. If we look at the financial implications for Ocean Yield, the joint venture will be accounted for an investment in an associated company, and the bank debt will therefore no longer be consolidated. This strengthens the equity ratio by about 2.1%. The impact on net profit will be limited due to the low amount of only $10.2 million that is raised in new capital. If we look at our portfolio of vessels with long-term charters, we now have 67 vessels wholly or partly owned. Largest segment is tankers with 29 vessels, followed by dry bulk vessels of 16 vessels. We now have a contract backlog of $3.2 billion with a remaining charter tenure of 10.3 years. We have a very modern fleet, only 4 years in average age, and this is very important. As it's important to have modern vessels in order to have low emissions. If you look at the vessels without long-term charter, the FPSO which is currently in layup in Sri Lanka. We're currently working on 3 different projects for the FPSO, and the work on these projects have been continuing despite the low oil price and the COVID-19 during the second quarter. Of course, the COVID-19 and low oil price have added to the uncertainty with respect to the project timelines. The FPSO operations has been classified as discontinued operations, and the vessels and related assets as assets held for sale. Net loss was for the quarter from the FPSO was $2.8 million, and we're working on further cost reduction related to the FPSO. Look at the connector. It's currently on charter to Ocean Installer. Has been on its way to China for most of the second quarter. It will now start working, and the charter will continue until September. Firm contract until start of September, but probably will stay on the current charter for most of September. Then we are in advanced discussions with respect to new short-term contracts thereafter. Had a net loss of $1.6 million in the quarter. Expect improved earnings in third quarter compared to second quarter. But second quarter was also substantially better than first quarter, where the vessel were in layup for 2 out of 3 months. If you look at FAR Senator and FAR statements, we entered into a restructuring agreement with Solstad in early May, and it's expected that that is closed in Q3. The agreement, according to agreement, we will basically cancel the existing agreement, and the net claim will be converted into shares in Solstad. Then we will enter into a new agreement with variable rate for 4 years, and the rate will be set by the average EBITDA in a pool of 7 similar vessels. FAR statements have entered into a 3-year time charter to Petrobras at an attractive rate level, and also one of the other vessels in the pool has entered into a similar contract with Petrobras. Net loss for the quarter was $2 million, as no bareboat hire was received in the quarter. Then I will leave the floor to Eirik.
Thank you. So if we go to the adjusted EBITDA and the net profit, we had EBITDA adjusted for finance lease effects of $86 million, and this is excluding the insurance claim on the Höegh Shaman, and this compares to $81.7 million in the first quarter. Look at adjusted net profit, $24 million compared to $18.1 million in the first quarter. So if we move on to the income statement, under operating revenues, we have recorded $26 million compared to $23.4 in the first quarter. The increase here is due to the improved utilization on the vessel connector. Finance lease revenues, $31.1 million compared to $33 million in the first quarter. This decrease is mainly relating to a lower interest rate during the quarter, as many of our lease agreements are subject to LIBOR adjustment clauses. Now, it's important to note that the reduction here is offset by lower interest rate expenses on the loans financing our vessels. Income from investments in associates was 5.6 compared to 4.9 in the first quarter. The difference here is mainly mark-to-market on derivative swaps related to the vessel financing. For the next quarter, we will also include the income here related to the 7 tankers that we now own in joint venture with Aker Capital. Other revenue, 27.4 million, and this includes the insurance claim of 26.3 for the Höegh Shaman, plus the charter hire until the settlement date, and also the remaining part of the prepaid charter hire. So that gives us then total revenues of $90 million compared to $61.3 million in the last quarter. If we go to operating expenses, $2.2 million, and this is solely related to the vessel Connector, which is operating on a time charter contract. And the increase here is due to then improved utilization for this vessel during the second quarter. So that gives us a total EBITDA of $86.3 million compared to $56.4 in Q1. And if we adjust for the finance lease effects and the insurance claim, the underlying cash EBITDA was $86 million compared to $81.7 in the first quarter. Depreciation and amortization, there's nothing specific to comment. And then we have impairment charges of $27.7 million, and then that is related to the Höegh Shaman. Financial expenses, 25.8 compared to 25.9 in the last quarter. Here we have a one-off expense of $3.6 million related to break cost of the SIR interest rate loan, which had a fixed interest rate in NOK, which was then attached to the vessels Far Senator and Far Statesman. We've now converted this loan from NOK into US dollars, since the underlying earnings of the vessels will be in US dollars going forward. So adjusted for this one-off expense, the financial expenses were $22.2 million compared to $25.9 in the last quarter. So we actually have a reduction here of $3.7 million. If we look at foreign exchange losses, 54.8 compared to 48 million of a gain in Q1. This is a result of the movements of the US dollar against the NOK that we saw during the quarter. The FX losses must be seen together with the mark-to-market of derivatives, and this is this quarter fully offset by a positive movement on the hedging positions. So there we see at the next line, change in fair value of financial instruments, 54.8 compared to a negative movement in the last quarter of 64.4 million. So the net FX and mark-to-market positions were zero for the quarter. That gives us then a net profit before tax of $20.5 million and a net profit for continuing operations after tax of 19.2. Net profit after tax from discontinued operations was 2.9 million, and this is related to the FPSO, and that gives us then a total net profit after tax, including discontinued operations, of 16.5 million. If we look at the adjustments a little bit in more detail, adjusted EBITDA was $86 million, including repayment of finance lease elements, etc. And also we have here adjusted for the insurance claim related to the Höegh Shaman. Also in detail here on this slide, we have the adjusted net profit of 24 million, and then we have adjusted for losses from discontinued operations, foreign exchange gains, mark-to-market of derivatives, and so on. If we move on to the balance sheet, there's a couple of items to comment this time. We can see on the left-hand side on vessels and equipment, this has been reduced now to $855.2 million as a result of the total loss on the Höegh Shaman. So the book value of this vessel has been written off and converted to an insurance claim. On finance lease revenues, this has been reduced to $1.447 million compared to $1.718 in Q1. And this is mainly due to the effect of the establishment of the joint venture with Aker Capital, in addition to ordinary finance lease repayments. And then investments in associates, that has increased to $173 million as a result of the JV, so an increase of about $10 million. And then we look at restricted cash deposits. This is related to our cross-currency swaps. That has decreased to $26.4 million, down from $56.4 in the first quarter. And this is also related to the currency movements that we have seen on the NOK against the US dollar, and also due to termination of some cross-currency swaps where the mark-to-market difference was settled in cash. So cash and cash equivalents, 106.8 compared to 106.4 million in the last quarter. In addition to that, we have 5.9 million in cash, which is held under assets held for sale. And also we have undrawn credit lines of $11 million available at the end of the quarter. On the right-hand side, interest-bearing debt has been reduced 1.893 million last quarter, and now this quarter it's 1.5 billion. In addition to ordinary repayments, the main reason for this is the establishment of the JV with Aker Capital, where about $227 million was removed from the consolidation. Book equity 826.6 and total assets is now 2.797 million, and that gives us an equity ratio of 29.6% at the end of the quarter. So I'm trying to move to the next slide, but maybe you can help me, Marius. There we go. Thank you. So looking at financing and CapEx overview. So at the end of the second quarter, we had CapEx commitment of $24 million related to one Newcastlemax dry bulk vessel on charter to CMB. This vessel has been delivered after the end of the quarter. So we had secured bank financing of $37 million related to this vessel. Then we had a sale of the Navigate MSC with repayment of related bank debt to that vessel of $17 million. And then the insurance proceeds that we expect to receive for the Höegh Shaman of $26.3 million. And here we will repay about $15 million of debt attached to that vessel. So that gives us an overall positive cash effect of these transactions of $33 million. Finally, I can also mention that we have committed to scrubber financing of 2 vessels, which totals up to $3 million. And here we can draw on $1 million of related bank debt attached to that transaction. And also, we have one maturity coming up in September relating to two of the Navigate vessels on charter to Navigate, 2 chemical tankers. We are refinancing that at the moment, and credit approval has now been obtained by the bank. So we expect to do the closing of that documentation in August. And with that, I will give the word back to Lars to summarize.
If we look at outlook, the short-term priority of Ocean Yield will be to build a stronger balance sheet until we see lower volatility and have more visibility with respect to a solution for the FPSO Dhirubhai-1. Long-term fixed-rate bareboat charters for most of the vessels to 18 different counterparties should contribute to reduce any negative impact on the company from the current market volatility. The board has decided to maintain a conservative dividend level in Q2 in order to contribute to building a stronger balance sheet and to position the company to capitalize on interesting investment opportunities going forward. And then we can open up for questions.
Then there's a few questions from the web. On the pipeline of new ship deals, leasing, developing, how do you see the pipeline of deals developing? In terms of deal terms, varies now compared to 6 to 12 months ago, and what kind of terms you will accept now versus 6 to 12 months ago?
I think that we have seen recently, although we have been very conservative due to the market volatility, that there's a number of opportunities for doing new deals. You can do that at somewhat higher returns than we have done historically. But probably also there will be slightly higher financing costs on the part of Ocean Yield to fund the projects. But it will be marginally more or improved returns is expected going forward.
Then there's a question on dividends. There are many aspects behind your decision to keep dividend at 5 cents. But what will be the single most important driver for you in adopting a higher dividend?
I think as we have pointed out now, to build a strong balance sheet it has been a priority in the second quarter. We're now close to 30%, which is starting to get at a comfortable level. We will keep the dividend at a reasonable conservative level until we see a somewhat lower market volatility, and hopefully also have more visibility on the FPSO.
Will you consider share buybacks with cancellation of shares as an alternative to new investments in vessels as balance sheet is strengthening and COVID-19 eventually wears off?
We are constantly considering buybacks towards new investments, but priority now is on building a strong balance sheet.
Question on Solstad Offshore. How many shares will you receive following the restructuring?
Yeah. It's expected that we will receive about 3.8% of the company after restructuring.
Then there's one last question on the Dubai one. How many lightweight tons does it have?
It has a lot of steel in Dubai one, so it's 44,000 lightweight ton.
What would you define as a strong balance sheet? The previous target was about 30% equity ratio. Any other metrics to use now?
No, I think in a normal market, 30% is a very acceptable level. We may want to have it slightly above 30% now with the current volatility in the market.
And there's no further questions from the web.
Okay. Then thank you everyone for listening in to our second quarter presentation.